You're watching silver hit €80 an ounce on December 29, 2025, the highest price Europeans have seen in 5 years. Your portfolio's up 48% for the year, maybe 62% if you timed it right. Gold's at €4,100. Best year since 1979. You're feeling vindicated. You were right about the metals. You were right about the inflation. You were right about everything. And then January 2nd happens. Silver drops 8% in a single session, then another 3% the next day. 11% in 48 hours, the largest crash in 5 years. That vindication you felt? It just evaporated faster than water on a hot skillet. And now you're lying awake at 3 in the morning doing the math you should have done at €80. Welcome to the silver rally that looks exactly like the last 2 times this happened, and both of those times ended identically, with exchanges changing the rules, with margin requirements exploding overnight, and with everyone who thought they were geniuses getting absolutely obliterated. My name is Leo. I learned investing in the United States, then moved to Europe and spent 9 years figuring out what actually works here. Which means I've watched European investors try to follow American precious metals advice and discover nothing translates cleanly. Different tax treatment, different storage rules, different currency exposure, different everything. If you're trying to navigate this silver situation as a European investor, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you is the framework that separates mania from structural shortage. And right now, we're seeing both at the same time. Here's what I'm going to prove to you today. This silver rally looks identical to 1980 and 2011. Same chart pattern, same media coverage, same retail investor euphoria. But the fundamentals underneath are completely different. And whether you make money or lose your shirt depends entirely on understanding which part is mania and which part is real. Because here's the thing nobody's telling you. It's possible for a genuine structural shortage to exist at the same time as a speculative blow off top. They're not mutually exclusive. And that makes this the most dangerous market environment you can possibly navigate as a European investor. Let's talk about what you've been told. Buy silver. It's real money. It's inflation protection. Industrial demand is exploding. Supply is constrained. The gold to silver ratio is way out of historical norms at 58-1. Solar panels need silver. Electric vehicles need silver. Artificial intelligence data centers need silver. The European Union has a 2035 combustion engine ban. That's real industrial demand that can't be substituted. And with silver up 48 to 62% in 2025, you feel like you're early to something big. But here's what they're not telling you about that narrative. We've heard this exact story twice before in the last 45 years. 1980. 2011. Both times, silver exploded. Both times, the fundamentals seemed bulletproof. Both times, the exchanges stepped in, changed the margin requirements, and the price collapsed so fast it made your head spin. Both times, everyone who bought near the top spent the next decade underwater. The chart patterns are nearly identical, 3 peaks separated by decades, and 2 of them were pure speculation with zero shortage. So the question you need to answer before you do anything else is this: what makes 2026 different? And the honest answer is, we don't have enough data yet, but we can build a framework to watch. Here's the critical distinction. In a mania, warehouses are full, inventories are stable or growing. But the price detaches from physical reality because leverage and speculation amplify demand for paper contracts. When the exchanges change the rules, there's no fundamental bid underneath. The price collapses back to the true supply-demand equilibrium, which was never that high to begin with. In a structural shortage, warehouses are empty, inventories are drawing down. Industrial buyers are competing for physical metal regardless of price because they need it for production. If exchanges change the rules and speculators flee, industrial buyers step in. The price might drop violently in the short term, but it finds a new equilibrium significantly higher than the pre-shortage baseline. The question is, which one are we in? And the answer is, we're watching both dynamics play out simultaneously. First time in history that's happened during a silver peak. Let me take you back to 1980. January 1979, silver was €5.50 an ounce. By January 1980, it hit €45. That's a 713% gain in 12 months. The Hunt brothers, 2 Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt, accumulated somewhere between 100 million and 200 million ounces of physical silver. That was roughly 1/3 of the entire global supply available for delivery. They weren't just buying silver, they were cornering the market. taking physical delivery, forcing a squeeze. It worked brilliantly until it didn't. The Chicago Mercantile Exchange, COMEX, saw what was happening. On January 7, 1980, they enacted Silver Rule 7. New rule: liquidation-only trading. You could sell your silver contracts. You could not buy new ones. The Hunt brothers' ability to maintain their position evaporated overnight. At the same time, Paul Volcker at the Federal Reserve was raising interest rates to combat inflation. 20% interest rates. The cost of holding a leveraged position became astronomical. March 27, 1980. Silver Thursday. Silver opened at 20 euros an ounce. By the end of the session, it was 10 euros, a 50% crash in a single day. The Hunt brothers were bankrupt. Their brokers nearly collapsed. And by 1982, silver was back to 4 euros 50 cents, 90% below the peak. The people who bought at 45 euros spent the next 3 decades underwater. What was the verdict? Pure mania. There was no industrial shortage. Warehouses were stocked. The price was driven entirely by 2 men with enough capital to manipulate the market. When the rules changed, there was no fundamental demand to catch the fall. Everyone who thought they were investing in real value was actually just participating in a monopoly scheme that ended exactly how monopolies always end, with regulators stepping in and everyone except the insiders losing everything. Now let's jump to 2011. Silver was 6 euros an ounce in 2008, right after the financial crisis. By April 2011, it hit 35 euros an ounce. Same pattern, explosive vertical move. Media coverage everywhere. Retail investors piling in. This time, the narrative was different. Zero interest rates. Federal Reserve quantitative easing. The European Central Bank expanding its balance sheet. The Eurozone debt crisis with Greece, Ireland, and Portugal needing bailouts. European investors were terrified their euros would be worthless. Gold and silver looked like the only safe haven. But here's what actually happened. The CME, same exchange as 1980, raised margin requirements 5 times in 9 days. Margin went from 4% to 10%. If you were leveraged, you either had to post more cash immediately, or your position got liquidated automatically. Guess what happened? Mass liquidation. Silver went from 35 euros to 18 euros in 2 weeks, 47% decline. By December 2015, it was 12 euros 50 cents, 72% below the peak. And for European investors, it was even worse because the euro to dollar exchange rate moved against them simultaneously. You got crushed on the metal and crushed on the currency. What was the verdict on 2011? Speculation. There was no shortage of physical silver. Industrial demand was real but not growing fast enough to justify 35 euros an ounce. Warehouses had inventory. The price was driven by quantitative easing fears and zero interest rate speculation. When the margin requirements changed, the speculators vanished. No industrial buyers stepped in because they didn't need to. They could get all the silver they wanted at 18 euros. Another generation of retail investors spent the next decade regretting they ever heard the word silver. If you've made it this far, you're already ahead of 90% of people. But don't stop now, because the next part is where everything clicks. This is where we figure out if 2026 is the same story again, or if something fundamentally different is happening. Let's look at the current situation. Silver rallied 48 to 62% in 2025. The gold to silver ratio hit 58 to 1. On the surface, it looks like a classic blow-off top. The relative strength index was above 85 on both daily and weekly charts. UBS called the move unhinged. Every technical indicator screamed overbought. Then came the 8 to 11% crash in January 2026. Largest single drop in 5 years. If you just look at the charts, this is 1980 and 2011 all over again. Pattern recognition says sell everything and run, but here's where it gets complicated. The physical market is showing something that didn't exist in 1980 or 2011. A 5-year cumulative deficit of 678 million ounces according to the Silver Institute. That means industrial demand has exceeded mine production by 678 million ounces over 5 years. That deficit had to be filled from somewhere. Existing inventories, recycling, government stockpiles. But those sources aren't infinite. Industrial demand now represents 60% of total silver production. The European Union's renewable energy mandates require solar panels. Solar panels require silver paste for conductivity. There is no substitute that works at scale. The EU's 2035 combustion engine ban means every new car sold will be electric. Electric vehicles use significantly more silver than combustion vehicles. Data centers for artificial intelligence are being built across Europe. They need silver for high-reliability electrical contacts. This is the first time in 45 years that a silver price spike has coincided with genuine, inelastic industrial demand growth driven by government mandates. Germany can't meet its solar targets without silver. European automakers can't sell cars after 2035 without silver. These aren't speculative users. They're manufacturers with production quotas and regulatory penalties if they don't deliver. Now, here's the critical part. Supply can't respond quickly. 75% of silver production is a byproduct of mining other metals like copper, lead, and zinc. You can't just open a silver mine when the price goes up. You're dependent on the economics of the primary metal. Even if a company wanted to open a new dedicated silver mine today, the timeline from discovery to production is 6.5 years on average, according to S&P Global. The United States Geological Survey added silver to the critical minerals list in 2025. That's not a speculative designation. That's a recognition that supply is constrained and strategically important. So we have inelastic demand growing because of EU regulations. We have constrained supply that can't respond quickly. We have a 5-year deficit that's drained inventories. And we have a price spike that looks exactly like the two prior manias. Both things can be true simultaneously. There can be a real structural shortage and a speculative mania on top of it. The mania amplifies the shortage into a price level that's temporarily unsustainable. But when the mania collapses, it doesn't collapse all the way back to the old equilibrium because the shortage is real. Here's the framework you need. In 1980, the baseline before the Hunt brothers was €5.50. There was no shortage. Warehouses were full. When the manipulation ended, the price went back to where it started. In 2011, the baseline before quantitative easing was 13 to 18 euros. There was no shortage. Inventories were stable. When the speculation ended, the price went back to that range. In 2026, what's the baseline? If there's a genuine 5-year deficit and European industrial mandates that can't be delayed, is the baseline 37 euros? 46 euros? 55 euros? We don't know yet because we've never seen this combination before. Here's what makes this time potentially different. During the 1980 spike, COMEX inventories were stable. During the 2011 spike, inventories were stable. During the 2025 spike, COMEX and London Metal Exchange inventories were drawing down even as the price was rising. That has never happened before. In every prior mania, the warehouses stay full because there was no real shortage. This time, the warehouses are emptying. That's not speculation. That's physical metal leaving the system. But here's the trap. Just because there's a structural shortage doesn't mean you can't lose money. If the exchanges raise margin requirements, speculators will liquidate. The price will crash. It might crash 40% in 2 weeks, just like 2011. The question is, what happens after that crash? In a pure mania, the crash continues for years. In a shortage with a speculative bubble on top, the crash is violent but brief, and then industrial buyers step in because they need the metal regardless of price. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The difference between making money and losing everything in this environment comes down to one thing: watching what happens to physical metal over the next 6 months. If COMEX and LME inventories stabilize after this crash, that tells you the shortage was exaggerated. The deficit was temporary. Supply caught up. The speculators were right to flee. If that happens, sell. You're in 1980 or 2011 again. But if inventories keep drawing down even after the price crashes, that tells you industrial demand is real and inelastic. Manufacturers need silver regardless of whether retail investors are buying or selling. If that happens, the crash is a buying opportunity. You're in a structural repricing, not a mania. Here's where it gets even more complicated for European investors. You're not just dealing with silver volatility, you're dealing with euro to dollar exposure. Silver is priced in dollars globally. When you buy silver in Europe, you're making 2 bets. You're betting silver goes up, and you're betting the euro doesn't collapse against the dollar. In 2011, European investors got crushed on both sides. The metal dropped and the euro weakened. Your 40% metal loss became a 60% loss in euro terms. Then there's the tax situation. In most European countries, silver has a value-added tax of 19 to 25% depending on where you live. Germany is 19%, France is 20%, Spain is 21%, Italy is 21%, Sweden is 25%. That means when you buy physical silver in Europe, you're starting from a 19 to 25% loss before the metal even moves. Gold doesn't have this problem. Gold is exempt from VAT under EU Directive 98/80/EC. So if you're buying silver in Europe, you need the price to appreciate 19 to 25% just to break even after tax. That's a massive structural disadvantage American investors don't face. Then there's storage. If you're holding physical silver in Europe, where are you keeping it? Zurich, Vienna, a private vault? Each jurisdiction has different reporting requirements, different insurance rules, different costs. And if you're holding silver ETFs instead of physical, you're trusting a counterparty. During a real shortage, do you believe the ETF actually has the metal, or are they lending it out and hoping you never ask for delivery? And here's the question almost nobody asks. If European industrial buyers are competing for dollar-priced silver while earning revenue in euros, what happens when they need to secure supply regardless of price? German solar manufacturers can't wait for silver to get cheaper. They have EU mandates to meet. European automakers can't delay electric vehicle production. They have regulatory deadlines. These companies will pay whatever it takes to get the metal they need. That creates a bid underneath the market that didn't exist in 1980 or 2011. But it also creates currency risk that American industrial buyers don't face. So here's the honest answer. We don't have enough data yet to say definitively whether this is different. The sample size is 1. We've had 3 silver peaks in 45 years. 2 were pure speculation. 1 is happening right now with mania layered on top of a potential structural shortage driven by European industrial policy. This is the first time in history that silver has spiked while European warehouse inventories were emptying instead of filling. That matters, but it doesn't guarantee anything. Here's your framework going forward. Watch the inventories, not just COMEX. Watch the London Bullion Market Association. Watch European exchanges. If inventories stabilize over the next 6 months, the shortage was temporary. The speculators were driving the price, not the fundamentals. If inventories keep drawing down, the shortage is real. Industrial demand is inelastic. European renewable mandates and electric vehicle deadlines are forcing manufacturers to secure supply at any price. Watch European industrial demand specifically. Are solar manufacturers stockpiling silver? Are automakers securing long-term supply contracts? Are data center operators bidding for delivery? If yes, that's real demand. If no, it was speculation. Watch the supply response. New silver mines take 6.5 years to come online. But existing mines can increase production in 12 to 18 months if the price stays high enough. If supply starts increasing in mid-2026, that's temporary relief. But if 75% of production is still byproduct mining and the primary metals aren't economic to expand, supply stays constrained. Watch substitution. Can European manufacturers substitute another material for silver in solar panels? In EV electrical systems? In data centers? If substitution is possible and economic, demand becomes elastic. The shortage disappears. If substitution isn't possible because of performance requirements or regulatory specifications, demand stays inelastic. The shortage is real. And watch the policy response. If the European Union delays the 2035 combustion ban or softens renewable targets, industrial demand drops. If they accelerate the timeline or add penalties for missing targets, industrial demand increases. You need to decide what you're actually doing here. Are you speculating on a continuation of the 2025 rally? If so, understand you're playing a momentum game with massive tax disadvantages, currency exposure, and the risk that exchanges change margin rules overnight just like they did in 1980 and 2011. If you're speculating, you need to be comfortable with 40% drawdowns and the possibility you're holding the bag when the music stops. Are you hedging against Eurozone monetary instability? If so, gold is more tax efficient. Gold has no VAT. Gold has deeper liquidity. Gold doesn't have the industrial demand volatility that silver has. If you're hedging, silver is the wrong tool. Or are you making an industrial demand play based on European renewable and electric vehicle mandates? If so, you need to understand the timeline. The 2035 ban is 9 years away. Can you hold through volatility for 9 years? Can you stomach a 50% crash in 2026 and still believe the thesis? Can you manage currency exposure and tax drag over a decade? Most people can't answer that question honestly. They want silver to go up because it's been going up. They want to feel smart. They want to believe they're early to something big. But when the exchange raises margins or the price drops 11% in 2 days, they panic. They sell at the bottom. They lose money. And then they spend the next decade telling everyone silver is a scam. Here's what I want you to understand. The most expensive mistake you can make right now is certainty. Certainty that this is just another mania like 1980 and 2011. Certainty that this is a genuine structural shortage that will keep driving prices higher. Both views are wrong because both ignore the complexity of what's actually happening. We have speculation layered on top of a potential shortage driven by European industrial policy in a market structure that's never existed before. The exchanges can still change the rules, the speculators can still flee, but the industrial buyers might step in this time. Or they might not. We don't know yet. What we do know is this. European investors face unique costs and risks that American investors don't. 19 to 25% VAT on physical silver, currency exposure to the dollar, different regulatory environments for storage and reporting. If you're going to play this market, you need to account for all of that in your position sizing and risk management. You need to know your break even. You need to know your exit plan if inventories stabilize. And you need to know your conviction level if the price crashes 40%, but inventories keep drawing down. 3 silver peaks in 45 years. 2 were pure speculation that ended in collapse. 1 is happening right now with fundamentals that look different, but a chart pattern that looks identical. The people who made money in 1980 were the ones who sold before Silver Thursday. The people who made money in 2011 were the ones who sold before the margin hikes. The people who will make money in 2026 are the ones who understand the difference between a mania and a repricing. And the only way to know which one you're in is to watch the data, manage your currency exposure, account for your tax disadvantages, and stay humble about what you don't know. Silver just crashed 11% after hitting 80 euros. You're either looking at the buying opportunity of the decade or the beginning of a 70% collapse. Right now, at 3 in the morning, when you're doing the math in your head, the answer is you don't have enough information yet. So watch the inventories. Watch European industrial demand. Watch the supply response. And whatever you do, don't confuse a vertical chart with a vertical thesis. The chart looks the same in manias and shortages. The difference is what happens to physical metal after the speculators leave. That's the only thing that matters, and we won't know the answer for another 6 months. What's the next topic you want me to dig into? Central bank policy? European real estate? The euro-dollar exchange rate? Drop it in the comments. Your future self is counting on you to make decisions based on data, not hope. Don't let certainty cost you everything when curiosity could save you.